Hello, welcome everyone to another episode of the None of Our Businesses YouTube show and podcast. With me, as always, is AJ Wheeler and Charlie Zigman.
Hey, everybody.
And as always, we're going to be jumping into talking about current events from an accountant's perspective, current events in business, that is. So let's do it.
All right. So our first article this week is actually one that comes from our way from accounting age. And the title of it is Talent and Tech Key to Future-Proofing Firms. So this is about accounting firms and kind of what's setting them up for the next round of business, kind of this business evolution and like really acceleration we've seen through the pandemic. And so they're talking about what they think are going to are the two cornerstones of future of accounting firms, period. And so what they're saying is, of course, talent. And so when they're talking about talent, they're often talking about, in the article at least, they're using verbs to describe people as like client service and interaction. And I think less about like the hardcore accounting is what they're talking about. And they talk about kind of like how that fuels the growth. And then technology, of course, is boosting efficiency. They don't really get too far into specifics, but I thought it would be a good starting point to maybe really reiterate our stance on how we feel about the future of an accounting firm and how it looks.
Yeah, I mean, I think those two topics are exactly the way I see it as well, is that, and what I often say is that as you prepare for the future, I see kind of two paths, and so one path is a technical path where you're leveraging technology to create efficiencies, and you basically become a software company. Like an accounting firm can become more of a software company. And I think they could potentially be deploying engineers to develop standardized solutions for their clients, essentially, where the client brings them data and the firm's proprietary solutions are able to then kind of churn through that and provide answers using technology. So I think that is a future of a potential future for accounting firms, is to become very like technology oriented in that way. I think the other path is this. Which is our path. We're not deploying developers. We're not actually trying to develop technological solutions that will manage our clients' data in a standardized way. We're approaching our clients and their problems with very customized solutions. So we're very human-centric solution, basically, which means that we have to gravitate towards the more complex, customized, less standardized kinds of things for us to work on with clients, things that can't be done by some kind of algorithm or software piece. And so, yeah, I really believe in the investment in people as being super important if you're going to take our path and really go down the path of providing customized service, customized solutions, customized problem solving for your clients.
Yeah, and I think this is like a theme that we're seeing develop, because I can tell from my inbox, I've been getting a lot more emails from companies that are trying to see themselves as a supplement to an accounting service. I had like an email recently where it's basically somebody tried to set up a team of software developers in other countries and then write emails to accounting firms to say, hey, we'll come integrate into your process and find ways to automate in what you're doing. And I think that there is a place for that, but I think oftentimes it just comes down to getting into the business and getting a firm understanding of what they're doing before any kind of automated solution can be really considered. The other thing I was thinking about with accounting firms and technology is just that a lot of the times it's the simple things that like, for example, how we share files, and there's a site dedicated specifically to that individual task. And then there's like sites dedicated to taking in calendar entries so that you don't have any interaction and a person can just schedule with you well into the future. And so I think some of it is just finding all the little automations and the little tools that help you get through, the easier parts of your day. And so that you can have the time available to focus on what is really the more interesting thing, which is the problems you're there to solve, And so, yeah, but I do think it's a way of the future, and I do think we're going to see more of this develop as time continues to go on.
I think it's worth mentioning too, probably, that size doesn't matter here. I think what does depend maybe on size is like internally created software, like you would see at a large accounting firm versus a smaller accounting firm that needs to then, and we're talking about, I'm talking about traditional firms in this sense, a tax or audit and attest kind of firm that does that. They're going to have to leverage the existing out of the box kind of software that they're going to have to use. And so I kind of see there's two sides to that equation, but I think the thing that overlaps both of them is weaving the technology with the people. All of these will have, client service aspects to them, and especially kind of the new wave of accounting firms that we've kind of seen come off, where they're offering implementation services like ourselves, or offering supplementary services outside of what a traditional accounting firm offers. Everybody's going to have to mix the technology and the rise of either out of the box software or something you're creating internally, I think, or you're just going to go the way kind of the old green books of general ledgers went when computers came around.
Yeah, I would caveat that with that when you talk about small firms kind of that take on services or kind of have a business model where what they're doing is rolling out integration of out of the box software. I don't think that the small business platforms, software platforms, are doing accountants any favors on that. They pretend to, and they kind of create these accountant programs, and they really try to say that they're partnering with accountants. But I'll just call it out. If you're talking QuickBooks or Xero or any of those kinds of platforms, we use them with our clients, and I think they're good programs. But I don't think that they are really thinking about me strategically. And I think that their goal at the end of the day is to make their program so user friendly that clients wouldn't need me for integration services, essentially. So my caution or my caveat on this point is, if that's the route you want to go, if you want to be kind of a firm that basically is a system integrator, I would go upstream and make sure you're working with the more complex systems where it's not as likely that the software vendor's strategy is going to be to try to make it do it yourself, right? A DIY, right? Because QuickBooks and Xero knows they really invest a lot in trying to make their interfaces as much DIY as they can, which is not really that helpful for strategically for us building a practice as accountants around them, as much as kind of more complicated packages like NetSuites or Intact or things of that nature, where those are just not going to be DIY packages. You need expertise to kind of implement those things. So yeah, that's my thought on it. Is if you're going to do that, go upstream and work with the more complicated packages.
Well, and what I was referring to, Ty, when I was talking about the smaller firms using the integration of out-of-the-box software, was usually those internally created ones that I was talking about internal software, like internal accounting software, such as like audit attestation software that's needed, and how kind of the big boys make their own, smaller guys don't. And also for implementation services, you're right. Usually the big boys do make their own implementation service software as well. And then, smaller firms are left stuck with the out of the box ones that you just mentioned.
Yeah. And on that point, you probably heard me say it before, is I don't believe that a firm's use of software internally to streamline their own processes in the service that they provide others, I don't really feel that is a competitive advantage. I think it's not a sustainable competitive advantage. Let's say it that way. It's a short-run competitive advantage if your firm is one of the early adopters of technology and it makes you more efficient in the short run than, say, other firms. But you have to imagine that all firms are going to adopt the technology that's necessary to make them competitive in the marketplace over time. So it's not a sustainable competitive advantage to say, well, we're going to just be more efficient than everyone else because we use the latest and greatest technology. Good on you, but other firms are going to use that technology too. And I think that's a key difference, because I wrote a post in the last few weeks, I had written a post on LinkedIn where I made this distinction, or I made this point. I said, hey, I think that accountants are missing the boat strategically if they're trying to rely on using out-of-the-box software, being ahead of the curve and using out-of-the-box software as a key competitive advantage. And somebody wrote back, and also I was piggybacking that with the statement that an emphasis in, accountants and accounting firms like to really emphasize process efficiencies as a way to profitability for their firms. And I said, if you focus too hard on that, you're probably missing the bigger picture kind of thing. And somebody wrote back, well, I really like the topic of process efficiency. And so, don't you think there is money to be made in being a process efficiency expert? And, I thought about that, and my response back was, yeah, I think there is money to be made in that, but not in the sense of how you apply it to yourself internally. Like, if you want to be a process efficiency expert and that's what your consulting practice is you're consulting with other clients and providing them with advisory services on how to be more efficient in their processes, I'm all for that. Like, if you want to be the lean Six Sigma process expert, all that stuff, I say I'm all for that. I think that is a thing, and I think you can make good money, and that's advisory. I'm not the one to do that, but I think that definitely is a thing where you can make money. I'm making that distinction between being an expert in that and selling that kind of advice to businesses versus saying that you're going to use that internally to create a key competitive advantage for yourself. I don't believe in that. and I think those are kind of two different things. So yeah, there's definitely a place in the business world for being a process efficiency expert. But if you think as an accounting firm, you somehow have that nailed better than any other firm, and that's going to be your competitive advantage, to me, that's just silly.
No. What about just the idea of like early adopters of really effective software that maybe other smaller firms didn't take the R&D to realize that some other product was out there that could have helped them, and then this other firm is focused on what tools can we use, and so they find some software more quickly and adapt to it maybe more quickly than some other firm. I agree that's probably not a large chunk of what's really going on there, but I can imagine a firm that maybe has that as some skill, some skill set that they value.
Yeah, I think that's true. And some of the firms I've been connected with in the past were at the forefront, small firms at the forefront of adopting technology. And I do think, obviously in the short run, if there's any efficiency to gain from adopting the technology, if you're the leader in doing that, then you might be getting some short-term advantage on that. And when we talk short-term, that advantage may last for a good decade or so. I think we've talked amongst us, we've talked before, and AJ shared, he's worked with a firm where, they were kind of a decade behind in rolling out, say, like paperless and electronic work paper type stuff, right? But I think it's difficult because it's hard to know. There's pros and cons, right? Because if you're on the front end of that and you're trying to say, well, I'm capturing process efficiencies, but you're one of the first ones doing it. So you're also making all the mistakes, right? And you're spending all the time on pioneering how this actually works, right? And then if you're on the back end of that, maybe you lose some process efficiencies that others gain by being early adopters, but maybe your implementation costs are much lower because the path to going, like if you're one of the last firms to go paperless, the path to become paperless is pretty well known right now. So you're not like you're not pioneering that process. And if you do it right, you could be pretty quick at it compared to the firms that did it early on, right? And so, where's that trade-off? Where's that equilibrium? I think that's probably hard to know. And I can't say that, just looking if I look at all the firms I know of in the Portland metro area and knowing some that used paperless early on and some that didn't, I can't really say that I actually see an enormous amount of difference in their success and profitability over the last 10 years where paperless became a thing, right? So it's hard to say that one firm was actually more successful than the other holistically because they adopted the technology early. I think there's too many factors going into that to know whether that's actually the case. It's a nice theory, but does it actually bear out? I'm not sure.
Yeah, I think that makes sense. And yeah, it's like also like hard to have one software that is so so amazing that it completely revitalizes the whole industry or changes, in order for that to really make sense, that software would have to be amazing. And I think that when looking at these types of softwares, there's not so much incremental difference between them that can really happen. But speaking of software, I've got another article we can talk about. I mean, we're here on a Zoom call, so I thought a Zoom article would be appropriate. There was an article in CNBC entitled "Zoom Revenue Grows 169% during the quarter, and the company doubled its revenue guidance for the year." And so, to be clear, I thought the headline was a little bit misleading, maybe just because it was growth was compared to the prior year. So they're saying that in the quarter that finished, the trailing 12 months for that period compared to the prior year was 169. It wasn't that growth in that one quarter all alone. And so let's see, shares still dropped like 4% in after hour trading because on a conference call, they admitted that they had higher than average computing costs. And so everybody's beliefs about how much earnings per share there would be didn't really hold as the business changed scale. And so they did one interesting thing. They gave all employees a one-time bonus equal to 2 weeks of pay to try to help them deal with the whole coronavirus situation, I guess. And then finally, one other interesting thing I found in the article was that they claimed they had 769 customers who paid over $100,000 for Zoom in the trailing 12 months. And I thought that was really interesting because I actually didn't realize that Zoom sold plans that were that large. I guess it makes sense. It's probably scaled just to the user base. But I don't know. Did you guys know that anybody could pay that much money to Zoom, any single company?
I hadn't thought about it, but I guess it makes sense that at the enterprise level, if you're using all the bells and whistles, you could be paying quite a bit.
Well, I'm surprised, Charlie, you didn't mention that Amazon has implemented Slack. You know what I mean? Or was it Slack or Zoom? I forget. Oh, Slack. Was it Slack?
I'm not sure. I saw something about Facebook. There was a Facebook alternative that they had tried to push that was supposed to be the answer to it. And I know that Google is also coming out with a video conference thing. So that was the other thing I wanted to talk about is whether or not you guys felt like this meteoric growth was kind of sustainable or whether or not these other alternatives are going to overtake it in popularity soon as it deals with some of those growing pains of, growing revenue that quickly.
Well, I mean, the quote, Gary V, probably brand is everything, right? And right now, Zoom kind of has like the video market like kind of sewn up. But I mean, it's not as if there can't be competitors here. If you look at like Spotify with the Joe Rogan deal, they're moving into like a video delivery system to be able to accommodate his like live YouTube, what is the YouTube podcast right now. So, I mean, and Slack just did that deal with Amazon. So it's possible that they would roll out like a video conference feature. And then the real reason they were talking about Slack and Amazon teaming up using AWS was trying to compete with the Microsoft Azure or Teams or whatever it is that Microsoft launched to try and get into this game as well. So, and there's the ever-present Alphabet or Google companies that have the capital and the infrastructure to be able to deliver something similar in some kind of form. So I think, if Zoom alone, I mean, if they can capture on their brand and be the iPhone of video conference chat, so be it. But I think brand wins out here, I think is what I'm trying to say. I have to agree with Gary V on this one because you're talking about a commodity at this point.
Yeah, I think that's right. It is a brand play because some of the things you mentioned, they already exist. Google already does have a video chat platform. They predating Zoom, and it can be used functionally, and people are choosing Zoom. Zoom has become it's like a verb, right? I mean, people are it's ubiquitous, and people are using it, and I think that's a classic power of brand is when, exactly as you said, you have something that is mostly, in my opinion, a commodity. I think there's probably some people out there that would maybe argue, oh no, Zoom for sure has these features that the others don't, and that makes it head and shoulders above the rest. But I think functionally, to me, it feels like a commodity. I think we could have a discussion like this on Skype or Google. You mentioned, Slack actually has video conferencing features already. And you mentioned the Microsoft's competitor with Slack. At Teams is kind of, I'm seeing a lot in the business community, people tell me that they want to connect via Teams. And I think that's kind of the Microsoft equivalent to Slack, which also has a video feature to it as well. And so, yeah, I mean, it is, that's right. It is Zoom's win here is becoming the easy to use branded platform that we now, instead of thinking, oh, let's have a video conference call, we think let's have a Zoom. And, that's good for them. That's where they're winning, is on creating massive brand awareness in a technology that otherwise, like you said, would just be a commodity going forward.
Actually, it's interesting, kind of the parallel. I used to be in construction, and if you talk to I don't know, average day construction workers, a reciprocating saw is a Sawzall, because that was the brand name of the first one that came out. Or a skill saw, well, that was like the Craftsman skill rotating saw, but it's just a circular saw or whatever. But instead of calling it, it's called by the name brand of, I guess, the most iconic one, or the one that was known the best. And so I think you're seeing kind of that same cookie cutter thing applied to now apps and technology. It's kind of same story, different years.
I've heard in a marketing class long ago that this can also go the other way. I don't know if you guys have ever heard of this or seen this in action, but I've heard of Xerox, I guess, was famous for learning, they did the same thing where basically everybody was going to say, okay, go ahead and Xerox this over to me or whatever. But they found that it became so ubiquitous that it started to just mean anything, and they didn't feel like it was accomplishing their objectives anymore. And there was a few other good examples. I can't think of them off the top of my head, but yeah, Xerox was one. And yeah, I think it can go too far in the other direction where it stops even meaning the original thing, but I guess Zoom isn't there yet, Nobody's saying Zoom me to mean Skype me. So yeah.
Seize the moment. So, yeah. All right. Next article I got is actually, this is a good one. I think it might spark some debate or conversation here. So this is from CFO, and it's 5 accounting and reporting considerations before reopening. And this is talking about, if you're looking at this at a later date, we're just entering, kind of moving out of quarantine and COVID-19. And so this is the 5 things that they say that you should consider, CFO should consider. And so forecast is the first one, and it's talking about kind of working with the sales and the rest of the team to come up with accurate, or at least critical, accounting estimates. So, and they talk about looking at impairment models and stock compensation. So this article is kind of geared more towards, I guess, larger companies or well-established companies that would have some of these kind of things to think about. And then they have divestitures. So they talk about shedding non-core, underperforming assets during a time of distress, and then showing that on your financial records so it's reflected correctly. Real estate expenses. So the ongoing mass experience with remote work has many companies considering permanent work from home plans for portions of the workforce. So how do you then, do you get rid of your leases at this point? Do you try to have a hybrid kind of thing? How is that going to work? And negotiating back and forth to get out of a lease, of course. Inventory management. So broken supply chains have been a defining feature of the crisis, and from grocery stores running out of toilet paper and such, but also good luck trying to find computer parts right now. So they're talking about if you need supply chain or you're using that inventory management that's broken, to find out how you can get back, how that's going to get back up and running. And then they talk about one-time costs. So, I guess what the tax verbiage for it is, an unnatural event, or the insurance, an act of God or such. So, but they're talking about companies may incur one-time costs as they manage through the crisis and the aftermath. So these costs may include severance resulting from headcount reductions, event cancellation fees. They talk about all that. Management should take steps to understand the new costs they'll incur upon reopening and determine which costs are one-time charges or now part of normal operations. So I kind of like to get your guys' opinion there. I mean, there's probably a lot to dig into if you guys have any opinions, or if it's, maybe not relatable to smaller clientele or mid-sized businesses.
I'm just excited to get the chance to talk about big bath restructuring. I don't know if you guys are familiar with hearing this or not, but whenever there's something huge that happens, you take a big bath and you make decisions in your financial statements that are, like you're saying, all these different ideas designed to put the questionable or the hard to swallow info all together into one period so that investors can look at it and view it, write it off as a special period. And so I don't have anything to add other than just that it's interesting to see that concept in action. I've only read about it in a textbook.
Yeah, I mean, for sure, to your question, AJ, it is definitely more of a bigger company consideration, because the context of this is we're talking about reporting, right? And whenever we're talking about reporting issues, financial reporting issues, accounting for financial accounting reporting issues as being an issue, as being something that a company should care about, it's only something a company cares about if they have external constituents that they're reporting to. And typically that is bigger organizations, or at least or sometimes your venture backed or your PE backed companies that may be in the startup phases where you happen to do reporting. I think what's cool about this is that for consulting or advisory firms in the accounting space, this lines out 5 areas that you could be consulting on, right? I mean, these are, because that's what this is talking about is, 5 areas where they're going to be these kind of financial reporting issues. And so kind of maybe going to market with services that are designed around these things might be helpful for some firms.
Yeah, absolutely. I think you're right. Kind of a roadmap to more fees. So join us this Saturday for $4.99 for our one-time Get More Client specials with this as the topic.
That's right. Yeah. We will have never done it ourselves, but we'll put together a fancy PowerPoint deck to tell you how to do it.
No, we're all about efficiency here. I'll just Zoom the article I just read and let them read through it themselves and then ask if there's any questions,
An automation right there. I like it.
Yeah.
All right. So I can keep us going on another article. So the big news that's been happening this week is that I've got an article from Reuters that the Senate passes a bill lengthening the coronavirus small business loan terms, and it's gone through all of the different stages through the Senate and the House and had the president sign it. And so basically what the key changes that they're doing is they're extending the forgiveness period from 8 weeks to, I believe it was 24 weeks, if I recall. And they're extending the repayment period from 2 years to 5 years. And so these changes are designed to try to make it so that more people will be able to take advantage of the forgiveness in full. The other change that they're making is they're making it so that a greater percentage of the money can be used on expenses that weren't just payroll. They dropped that percentage from 75 down to 60. And so I guess I wanted to get your guys' take on whether or not you think these types of changes are good changes, or whether or not this is more of an attempt to just fix something that was, not set up correctly in the first place, or what you guys think about it.
I think I saw in the article, or one of the articles on this, that there's some skepticism as to whether banks will actually service these programs with this change of a 5-year loan period, because these banks may not want to carry loans for 5 years at those preferable rates. And I remember kind of looking at something else on this, about, well, you've got a lot of people at this point who already have their PPP loans under the old terms. Can they then convert what was their 2-year loans to a 5-year loan? My understanding was that this new law was basically leaving it up to the banks to negotiate that. They were like, yeah, you can if the bank and the and the borrower agree. So I'm like, well, good luck with that, right? I mean, I can just imagine for my little PPP loan with Wells Fargo that they're gonna give me a big thumbs up to just convert my 2 years to 5 years. No questions asked, right? No problem. I'm sure that'll happen. So yeah, I mean, I think that's probably one of the glaring problems with this, and I guess time will show us how the banks actually are going to react to it now that the president just signed this law, right?
Yes.
Yeah, literally
As-
today.
Yeah. So on the date that we're filming this, the president just signed this into law. So we will start seeing probably as early as next week how the banks actually go forward with it.
Well, and they said there's already identified drafting errors in the bill that they're working on correcting. So much like anything else in this entire arena, everything that happens is subject to change, and we're going to find more and more issues. One of the drafting errors they were talking about was that they felt like it made a cliff to where if people were spending 59%, for example, of the money that they got on payroll expenses, that they would then get none of the forgiveness, even though they were substantively so close to the 60%. And so that was one of the kind of finer points they were trying to iron out, I guess. But yeah, I think it's going to continue to change, and it's hard to know exactly what it will turn out like. But to give it some scale, it was like 510 billion worth of loans that were out across 4.4 million loans. So yeah, to imagine all of these banks going through a renegotiation, like you mentioned, is just silly at this point. The other thing that they did, or that they had argued for, was that they wanted to give all of the smaller loans, anything under $1 million, the presumption of compliance. So they didn't want to go through the steps of trying to test whether or not they were in line with the terms. And so I thought that was interesting too, because it just forces them to pick a threshold of like, this is where we, these are the loans we care about, these are the ones we don't. And, so I thought it was kind of an interesting precedent.
Yeah, I like that. And then another suggestion that I saw them looking at for potentially the future was just flat out giving full forgiveness for any loan under, I think they said like under 150 or something was the proposal. Yeah. So yeah, again, with my small little, we're well under 150 for our little businesses, PPP. So yeah, I love that idea of not even having to apply and just having it automatically presumed to be forgiven. If that were to go through. Now, to be clear, that wasn't in the current law that we're saying was signed today. That's a proposal for the future. But I think that's kind of that is par for the course here, so to speak, in the sense that I think the article we were looking at even said, these are the new rules for now, but there's probably more to come. So, yeah.
Well, I want to thank them. I mean, it keeps us with something to talk about every Friday. So
yeah,
I mean,
the subtitle was "By no means will this be the last major change." So I agree completely. Like before you even get into the article, they're letting you know like nothing means anything anymore.
Yeah, plenty of fodder for discussion. That's right. Yeah, and yeah, I mean, I think I would say like the 8 to 24 week thing. That part, I mean, nobody really can object to that, right? Neither the banks nor the borrowers are going to have any reason to object to that. So that's definitely kind of a hands down good for everyone policy change there.
all right. So our next article is how to keep the bankers and investors on your side during a recession. So this is kind of so they kind of list them out as bullet points here. Institute a company-wide decision-making process and create a roadmap. So they're wanting you to show the bankers or your investors what you're planning on doing in your post-COVID-19 reopening or during a recession. If somebody's reading this after COVID-19 and you're headed into a recession, create a roadmap, prepare for a range of situations.
I want to interject there real quick just on that first one is that is so often what I see with small businesses is that they don't have a roadmap or, a roadmap like this is in a company-wide way of making decisions. It's part of what we talk to clients and businesses about, what we say having a planning model for your business, right? And what I find is that so many businesses don't have that until they have to have a discussion with their lender. And sometimes it's to get a loan in the first place, or sometimes it's like in a situation like they're writing about here, where maybe you already have debt outstanding and you might be running up against debt covenant problems or whatever, right? And so then the company rushes to create that process or that document just to show the lender. And so my advice or my thought on that is that the lenders can smell that, right? They realize when you put something in front of them that doesn't actually tie to how you operate the business, they see that. And that's often like they start, when they start picking apart your forecasts and really questioning hard what you're doing, it's usually because they realize that you created that just for them and that you don't actually operate your own business by that forecast. And so I think, on this topic, I would say, and it's something that's really near and dear to us because we consult on this exact issue with our clients. This is one of the main things that we try to get our clients to do, and that we advise clients on, is having a planning model and a planning process in place at all times, so that when you do have these discussions with lenders and investors, you can have them in a way that is genuine and not fabricated just for that discussion. You can show them, here's the model we actually operate our business by, and have that discussion with them. And I think that's a lot different than throwing one together just to show them in hopes that they might give you money, or that they might not call your debt because you're running on tough times.
All right. The next one is demonstrate what you've already done. And I think this speaks to what Ty just said. If you have a planning model, or you've done planning, or you're using some kind of metrics by you're running the business, show them that you've already used it, or show them that you've paid back the recent debt or lending and how you did so financially. This third one here is be a credible voice to your partners. And I think this comes from what Ty was just, if you have a relationship with your banker or investors and you've shown them over time that you're a credible voice and you speak with facts and the backup, then that helps. When your capital partners offer help, accept it. And I think that's kind of a no-brainer. And when the time is right, be ready to go on the offensive. And I think they're talking about asking for funding here in this one.
I'll back up and comment on that. Accept help from your capital partners. It seems like a no-brainer, but so often I see entrepreneurs playing the cynical move of, oh, we just want money from those folks. We don't want to listen to them. And I think kind of the point that the article was making is that, the people that you're asking money from are business people. They work with a variety of businesses. They have a variety of experience. And so it's kind of foolhardy to just, try to have very one-sided conversations of just trying to get money from them and not taking advantage of the advice that they may have as well. When you have access to that kind of experience, and if people follow our podcast or our show regularly, you've probably heard me say in the past, with the caveat that understanding that their advice or their expertise may be very narrow or very specific to the way they come at a problem. But still, I think in my mind, it's like, take advantage of all the experience and expertise you can. Just be aware of where it's coming from. Be aware of who's giving it to you and what the context and limitations to what you're getting in that advice would be. But yeah, I think as obvious as it may seem, I see over and over again entrepreneurs who don't do that, who take money or resources from lenders or investors and then really don't take an opportunity to utilize them for business advice.
Here's the other thing I think is really relevant to add here. One of the other kind of points you were talking about, AJ, was sort of managing the relationship with your banker and keeping in touch with them. And I just want to say, as somebody who's been through this whole rigmarole with bankers before and having issues, that one of the mistakes that I made and that I would advise other businesses not to make is to not get overly reliant. If you feel like you have a friend that's a banker, or if somebody that you've worked with for a long time and maybe you've established a history where you feel like, hey, everything I've done is right. Sometimes in larger banks and whatnot, the person pulling the strings isn't the person you're talking to. And so often you end up feeling like you have an ally on the bank side, and then a change up of who's of management above that person, or even just a change up in how that department is run leads to an entirely different conversation than you had. And so it's good to have a generic plan that will work to even somebody new at the bank, because it's always going to be a change up of the guard. And so whatever plan you have has to be generic enough that you can get someone new on board quickly, because you can't always trust your longtime banker, you know. And so
I think that goes hand in hand with what I was trying to get at with understanding the limitations of the person you're talking to and their advice is I think another way of kind of saying what you're saying, Charlie, is seeking advice from your lending partner or whatever representative of the bank that you're talking to, seeking their professional advice or their experience. Don't confuse that with negotiating with them as if they have the authority to speak for the lender or the bank or the institution as to the way things are going to be in your partnership, right? But that's totally different, right? So if I'm talking to a relationship officer at a bank that I'm working with, and I know they have a lot of experience and I value their experience and I'm seeking their advice, I don't want to mix that up with thinking that as I'm talking through their advice, that I'm actually negotiating with them as if they have the authority to make decisions on behalf of the bank in our particular relationship. They probably don't. It depends on the circumstances, but in most cases they probably don't.
I actually have a story. I was auditing 401k plans, and this poor company had, done the pay plan through their payroll provider. And so what the payroll provider did was they sent out one of their sales teams to do this 401k service for the company. And of course, the company was relying that the 401k expert was going to be on their side or give them relevant information. Unfortunately, the salesperson was a salesperson and talked him into basically allowing anybody that worked at this company to have access to this 401k, which immediately meant like within the first year, they were subject to audit because they had gone over the threshold of that amount. And you're not talking about a small fee for a 401k audit. And it really put the small company in jeopardy because they had basically relied on the service provider that was selling them a service to give them straight information without consulting somebody else that would have known better. And so I think, that relationship goes both ways, where you need to really hedge your bets, especially when you're buying a service or you're being served, your partner is gaining something off of that.
Yeah, that's what I've experienced. The salespeople will always tell you anything that you want to hear in order to get the product sold. And a lot of times you don't realize you're talking to a salesperson until it's far enough along in the engagement that you realize, okay, this person's, this guy's trying to sell me something. Somebody I thought was on my side is, like you said, a salesperson. So from Business Insider, we've talked a lot about this PPP loan, and I've got an article entitled "Mark Cuban and a bank CEO who first connected over Twitter built a free site to make it easier to apply for PPP loan forgiveness." And so what's happened is that Mark Cuban and the CEO of Citizens Bank of Edmond, whose name is Jill Castilla, teamed up to create this bank. They were both on Twitter talking about how difficult the 11-page PPP loan forgiveness application is that was released by the SBA. And so they teamed up and they built a site that basically walks you through the interview and results in a shareable PDF that is supposed to be easier to fill out and do than the original application. And so the other thing I thought was interesting about it is they teamed up to try to help, in which what they did is where Mark Cuban set up a fund so that Citizens Bank of Edmond could allow its customers to overdraft their account by up to $900 as a way of helping them through their stimulus while they wait to get their stimulus money. And so I guess I thought it was interesting to see these two CEOs kind of, working together over Twitter, and then just see some of the different ways that they're trying to play a role in this whole situation. And so I want to get your guys' take on, I guess, do you think that the loan forgiveness application is cumbersome enough to need its own third-party website to administer? And what do you guys think?
Well, I haven't looked at the forgiveness process in detail yet, because I don't think most lenders are actually taking forgiveness applications yet. So I thought what was interesting about it is the proposition that, oh, put your information into this site, it pumps out the SBA forgiveness application, and then you can just hand that to your lender. I think that how that actually works would be very lender specific. So I don't know if that actually is going to work that way. If you're working with a commercial bank, that they'll just kind of take the output, even if it's in that format of the SBA, if they'll just take that output and do it that way. But I mean, it certainly could maybe give you a head start in making sure you have all your X's crossed and your T's, I should say your T's crossed and your I's dotted, right? Maybe it helps you kind of work through that, so that when you do fill out whatever your lender has that's a specific application to them is more is ready to go, so to speak. But yeah, I questioned that and kind of looking at it as to whether the use of that service would actually be as easy with any particular lender as they suggested it would be. But beyond that, I just thought, well, that's amazing. I mean, how cool that these CEOs got together and did this. And as the article expressed many times in it, that it was to no profit of the CEOs of their companies or their organizations that they were doing this. They just and Mark Cuban being one of them, kind of he's been somewhat politically active in his discussion about the things everyone's going through lately. So yeah, it seems in line with his desire to kind of be a champion of business and small business. And so I'd say good on him. I think it's great. I think providing that free service, and if it does help people, then wonderful. I just don't have a clear vision of exactly how that's going to work in detail yet.
And I would say, I actually clicked through to check out the application process and started it to see if it was, what it looked like. And so, I mean, it looks legit. It says free all around it. And I got as far as putting the business information in, and there was no credit card to enter or anything like that. And they made it very clear there wouldn't be. And there's also the very, the disclaimers, kind of like yourself preparing taxes or something, it's all the information entered. We're just helping you put this information together. But I'm kind of with Ty. I think banks from bank to bank are going to they'll probably all have general requirements, but are probably going to want you to fill out their forms or follow their fit and package that they'll deliver to you.
And one more thing I just thought of, we just reported today that there's new law on this. So it makes me wonder if the SBA is going to be changing their application in some way anyway.
Well, you just stole the words out of my mouth. I was going to say, and as we just reported, I mean, they're changing. So is this website kind of up to date, even as of today?
And it made me laugh too, because they set a record, apparently it's really hard to get a .bank domain, and they set a record on the world's fastest approval of a .bank domain to get this site up and running. And then immediately after that happens, the loan forgiveness period was extended from 8 weeks to 24 weeks. So suddenly this huge feat of technology is totally irrelevant because it could have taken 8 weeks longer and would have had the exact same outcome. And so I just got a kick out of that. That's 80% of the reason why I wanted to bring up this article.
Yeah. Well, I think I would double down on, I think it's great that they're doing it, and they're doing it for free. So to the extent that it may not work perfectly in all circumstances, so what? That doesn't detract from the public service that they're trying to achieve here. So that's great.
And it's not even like the free tax software where they make you pay for estate filing or print it out. It's actually free. But it does very much look like that when they walk you through the TurboTax or something. They kind of has, the same fit and feel.
That's awesome. I want to use it myself then.
Right?
Yeah. I like it.
Yeah. You'll have to report back then, maybe we can do a screen capture and blur out all your,
Well, I was a little miffed when the loading indicator was a Dallas Mavericks ball just sort of spinning around. I thought maybe that didn't need to be there, but other than that, it was pretty good. Pretty good.
Are you serious? Did they really have the?
No.
Okay.
Oh yeah, I was thinking, really? Okay.
I just love that idea of
it says at the bottom, sponsored by the whole. So last article is actually another technical kind of article, short-term cash flow forecasting. It's the metric of the month for CFOs. So he kind of goes into talking about basically how much time it should take you to do a short-term cash flow, and then kind of what a forecasting foundation is, real accurate understanding of your cash flow inflows and outflows. So they talk about kind of the stumbling blocks to getting that going again with post COVID-19. And so he kind of goes through the steps here on how to understand that. And he's talking about calibrating your forecast 30, 60, 90 days out kind of. And so I kind of like to get Ty's input here because he's been doing a lot of short-term forecasting and kind of get his idea or kind of his checklist maybe for everybody out there on what these important short-term cash flow hiccups would be coming out of, or in kind of a re-emerging from the global lockdown would be.
Yeah, I think I would defer a little bit to Charlie because I think he actually has more experience with truly short-term cash flow forecasting. In the sense that typically, I mean, when we're advising clients, if you actually need like the kind of short-term cash flow forecasting that tells you, here's how much cash we're going to have every day of the week, for the next week, and then we need to do another short-term cash flow forecast for next week. I see companies that get themselves into that situation all the time, but I truly believe, I mean, there's a lot of systematic problems with the business that lead to that scenario, and that's not where we want to be. I think that's not, you don't want your company to be in a scenario where they have to do that kind of short-term cash flow forecasting. I mean, if you don't have the working capital that you can basically forecast cash flow on a monthly basis and revise from there if it's not right, and be okay, you're kind of in a world of hurt, and it ends up burning up a lot of, in my experience, it does burn up a lot of time and resources to try to maintain these short-term cash flow forecasts. And I think this article was almost written as a rebuttal to my attitude on this, because what the article was focusing on is how top performers can do these short-term cash flow forecasts in a very short period of time, and how important that is that you can churn it out in a short period of time. Yeah, okay. I mean, obviously, yeah. I mean, if you're in that zone and you have to do that, the fact that you can do it very quickly is going to be a very important skill. But still, I mean, if your cash flow cycle is such that you're worried about running out of cash on a daily basis and you need to do something like this, that's not a good place for the company to be. And so we don't practice in that area very often. We run into it, it happens, but not very often. But I know Charlie's had it happen with client work that he's done.
Yeah, so I can talk a little bit about things I've done to try to help that. Because yeah, like you said, it's not where you want to be. It's not the plan that anybody wants to be in, but you often find yourself there. And so in the situation that I was in, the things that I found helpful that are like practical advice to people who are in that situation was basically two things. It was getting integration from other people. A lot of times the problem was that there were other people in the company who knew what mattered, who knew what was going to be spent, or who knew what money was going to come in. And so getting a system that integrated them so that they could easily and effortlessly inform that process without having it be burdensome, it was kind of the first thing. And then the second thing is to just try to think about everything as an equation that has variables that you can define. So like if you're looking at what you're going to spend total in payroll, you got to think about, well, what are the different factors that go into that total cost, and how much of those can I systematically lay out so that at the end of the day, it's more a question of just reviewing those assertions rather than trying to start from a really zoomed out perspective that isn't auditable. And so I think with those two things, with getting the right people put into tools, like for us, a lot of the times it was just a Google shared sheet. You start in a Google sheet and get other departments so they can type numbers into it. And then you start asking the questions, what's going to impact cash flow, right? What do we think about those things? And then the more you just kind of, you let them take their part in it, and they have, variables that they feel matter. And so I think that through doing that, you can get to a pretty good system, but like Ty said, it's no substitute for the long term. It's more of a Band-Aid for if a company is tight and needs to just get through, needs to know what's going to be in the bank in the next 2 weeks or 3 weeks, then that's probably the best way to go about it. But it's always a challenge, and it's never a fun game to be in, I'll tell you.
Yeah, and the paradox of this is that you need somebody who's pretty experienced and business savvy, like a Charlie, which is not a cheap resource. So when you're burning through time with experienced business savvy resources, because you don't have money, right? That's why this is happening. You don't have money, so you're having to forecast your cash flow on a daily or weekly basis. But in order to do that, you need somebody who's really plugged into the business and knows how to do this, and has, which is an expensive resource. So there you are, right? I mean, you don't have any money, but you're somehow going to pay for an expensive resource to try to keep you going above water, and that's just super problematic.
Well, and you've also got the question of like, how actionable is the knowledge that you get out of that process? Because if you get to the end of it and you find that you can't make any kind of meaningful decision from it, if the forecast says you're going to be broke in 2 weeks and you don't have an answer for that, then that isn't going to necessarily solve it. So a lot of times that forecasting process just ends up being, like I said before, but a Band-Aid for a more meaningful discussion, like you're saying. Yeah. All right, everybody. Thanks for watching the podcast. Be sure to like and subscribe, and come back next week to see what's happening in the world of business. Thank you, everybody.
Thanks.
We're on.